Welcome everybody back. We're getting towards the end of the day. You guys have been absolute troopers. I know it's been a fact-filled day. When I've been involved, it's largely opinion-filled day. This one is one of my absolute favorites. David is a return customer to Entering the Fall. He was one of our first guests. I've been incredibly fortunate to know David, who really needs no introduction, as founder of Greenlight Capital, one of the foremost activist investors of our generation. I met David back in 2000. We've met a couple of times before this, but the first time we really sat down in detail was in 2017 or 18. I can't remember which one it was. He generously took time in his office to sit down and hear my crazy theories about passive investing. And more than any other person, I would argue that David has been the voice that has expanded the conversation about passive investing by introducing the idea that markets are broken. And we all feel that in some way. We know there's something happening that's not right. My work is largely focused around trying to explain what that is. David saw it symptomatically and very much like I think, somewhat uniquely, said, I'm going to change what I'm doing because of this. And so when he introduced that thought process, it really expanded it. Thank you for joining us, and thank you for being a great friend over all these years.
Thanks. It's a delight to be here. I see we have an hour. I know second prize would be 2 hours. So let's have a great conversation.
So the title of the session is called Still Broken, More Broken, Never Broken. And the question that you raised in an interview with Barry Ritholtz, which led to me actually then getting to be on Barry Ritholtz as well, was you view the markets as broken, that something has happened. Do you still feel that way?
Oh, very much so. Well, it depends. It depends on what you think the function of the market is.
Yeah.
So if you have a traditional view that the function of the market is to, allocate capital, reward things that have good returns on capital, punish things that have bad returns on capital, and thereby encourage corporations to be efficient and to create positive returns on capital or incrementally. If you think that that is the function of the market, then it's ever more broken. If the function of the market is an opportunity for people to amuse themselves, enrich themselves, trading, trying to solve the puzzle of what the stock is going to do an hour from now, 2 hours from now, 3 nanoseconds from now, well, then the market is functioning great, because that's what we're doing.
It's interesting. So, you and I both come out of the value school, although you've stayed true to it in a way that I never did. If I think about discussions I have with other managers, right? So I talk regularly with people at pod shops, for example. One of the things that was highlighted for me is if you even bring up valuation in your discussion of an idea within a pod shop at this point, it largely gets discarded immediately because there's no catalyst, there's no rationale for it, and in many ways they've learned to take the opposite approach. Are you having similar conversations, or?
Well, I don't have the conversations. I don't talk to people in the pod shops. I'm too much of a recluse, just reading my stuff and doing my things and stuff, and so I don't think I have those kinds of conversations, but I sense what you're saying is certainly true. The abandonment of any sense of traditional valuation as a discussion point is so complete that when people do talk about stocks, they almost never discuss the valuation. Or if they do, they say something, but it doesn't actually mean anything. So you might say, hey, it's at 19 times revenues. And maybe that means something, but maybe it doesn't mean anything. It's just the number that you're there, and you say, well, maybe it should trade at 22 times revenues. And you say, well, what's the difference between 19 times revenues and 22 times revenues other than like 15%? But it doesn't actually mean anything because the metrics that are used are meaningless.
This is part of what I try to explain to people about shouting about valuation, right? When you're talking about a market that's trading at 25 times forward or a 39 times Shiller PE or whatever number you want to use, I describe it like you're shouting the emperor has no clothes at a nude beach. Everybody already knows this, right? Nobody cares. And so the words have no meaningful impact, even as we all kind of think, if I could just say it in a better way, if I could communicate it more effectively, that maybe it would have some impact. But I just don't think I don't think there's any possibility of that.
Look, we've taken out the class of professional analysts or investors who used to be dominant players in the market, where their strategy was, generally speaking, like if I go back into my career 20 years ago or whatnot, the dominant players in the market were the long-only mutual funds. And you could criticize what they were doing, but in a broader sense, what they were mostly doing is trying to find things that they thought were undervalued. That didn't mean they were value stocks as opposed to growth stocks, but they might think a high multiple stock was undervalued, but they would have a view, like it's 30%, it should be worth 30% more or 50% more, and you would hold it. You buy it and you hold it, and as long as your thesis was working, and you're going to make S&P plus 30 or S&P plus 50. It might be over 2 years, it might be over 5 years, it might be over 10 years. You make S&P plus 30 over 10 years, that's still S&P plus 1.5 or 2, which isn't so bad if you're a really, really big long-only mutual fund. And their goal was to buy things that they thought would outperform the S&P over a sizable duration. If it happened quicker, so much the better, but they really weren't there to try to buy something in September that they were going to sell in October. In fact, if they decided to buy it in September, they'd be still buying more of it in October and November and December, and it would take them 6 months to get into their position, and then maybe 5 or 10 years from now, they would take 6 months to get out of their position. And so they were taking that, and this was the dominant flow in the market. And what this meant was there were serious people that were analyzing all these companies and directing their capital in a way that led to make stocks generally converge towards value. So if they got out of line of value, there was money there to try to drive that convergence. And since we've taken that group out of the market, we've taken their money away, we've taken their assets away, we've taken their fees away, the fees that they have on the remaining assets are smaller, they've reduced their analytical staff, right? And mostly they're figuring out what they're going to sell when in order to meet whatever redemptions, because it's all being reallocated over time into passive, right? So as you've taken that away, you no longer have a dominant force in the market that helps shares converge towards value. So now whether they converge towards value or not, it's due to other forces, and those forces are not aiming towards value convergence. They have opinion about price, but they don't have opinion about value. And price is defined as, well, what is the price going to be during my horizon, which may be very short.
Mm-hmm. I mean, just to quantify some of the data that you're highlighting, I share this presentation, I mentioned it earlier today in my presentation. There's a slide that refers to the changing character of market transactions. And in 1995, which is roughly when you and I both got started at this business, 80% of the trading activity was active managers. Today, it's 10%, right? In 1995, 10% of the market was speculative retail. Today, that's 17%. So one of the things that I encounter is I often focus on that in terms of the reduction of the active manager community, but simultaneously there's been an amplification of the speculative retail trader that in many ways, as you're describing, has been trained in a totally different fashion.
There's been that, and also the remainder of the active community has changed. Mm-hmm. Right? So if you talk about your pod shops, or you talk about the quantamental strategies, or you talk about all the technical strategies and all the momentum strategies, which is a dominant feature of what remains of the active, these are also not, call it market efficiency convergers to value strategies. Mm-hmm. And so the amount that is actually traditionally somebody sitting down and saying, I think this company is worth more, how much more they can figure out, and I'm going to deploy capital because I think eventually it will be worth that, based on some kind of a quantitative framework relating to valuation, it's so small. I mean, I doubt it's 2% of the trading.
It sounds directionally correct to me. I will tell you, one of the discussions I had recently was around what comes next in the AI component, right? And a pod manager at a hedge fund was flagging Reddit. He's like, all the data is being trained off of Reddit, and Reddit is not being adequately compensated for it, right? And so at some point, OpenAI may have to pay them a lot more money for the data. And, you know, the discussion was, well, is that actually true? Or once Reddit has actually been fully mined, is anyone going to go to Reddit if you can go to an AI that has it already presented to you, right? One, it was surprising that hadn't actually occurred to them. But two, their response was what sent my blood cold, which is, yeah, people won't figure that out for a long time. Right? It was just this, you know, we want to identify the next buyer. To be very fair, right, that is effectively Keynes's insight on the Keynesian beauty contest. I'm not trying to figure out what I think is super attractive. I'm trying to figure out what everybody else thinks is super attractive. You invest differently, though. You're somewhat interested in the what's the fair value. Once everybody has kind of come to their decision, what is the price going to be then? And what's my return off of it at that point? Is that a reasonable interpretation of the difference?
Well, there's two ways you can get at what has transpired. One is you can say, if I can't beat them, I can join them. And you're going to out-pod the pods or out-quant the quants or try to front-run retail or figure out what's going on Reddit and who to follow and who to do that. And I think there's a lot of effort to do that. And I don't think that drives efficiency, but there you go. But the other aspect of it is you get the result of this to be great distortions in some securities that are fundamentally unloved. And what happens once they reach a certain point, in a sense, it just no longer matters because you're not paying 11 times earnings because you think the earnings are going to be a little bit better and you think Fidelity will buy the stock in 6 months or a year, and if Fidelity doesn't do it, T. Rowe Price will do it. You're buying it now at 5 times earnings or 6 times earnings. And if you have an unlevered balance sheet and the earnings aren't collapsing and you pay 5 or 6 times earnings and you can have a fair amount of that allocated back to you in dividend and buyback, you're making a return out of the cash flows of the company. And so we underwrite to the view that nobody cares about these stocks and nobody's going to care about these stocks. Now, it may turn out we could get lucky and somebody could notice or they could care or the machines could decide they like one of these stocks for a few minutes. And then we get a better than expected result. But the base analysis is, what if nobody ever cares? And it's the old comment like, well, if you were going to buy a stock and put it into a jar and not look at it for 10 years, would you be happy owning the stock? It's kind of that analysis, except we really don't have to commit to a 10-year lockup. We can always change our mind if we decide that we're wrong, but we're sort of underwriting to that kind of a thesis, and I think we're underwriting to to good structural return that we should be able to generate from these companies.
Yeah, I mean, the advantage of what you're doing, so you and I have talked about this several times, this concept of endogenous liquidity. Ultimately, the firm is returning the capital to you through its profitable operations, share buybacks, dividends, et cetera, rather than you relying on a greater fool component of somebody else showing up. If that happens, you're perfectly happy to sell to that person, but you're not counting on that person being there.
That's right.
So that is, I mean, that is almost the opposite. You and I lived through the period of 2004 to 2006 in the hedge fund community. This was kind of the heyday of you'd go to an idea dinner and there would be an analyst and you'd have a book, on a company, and we basically all competed for how deeply we understood the operations of the business and the cash flows and everything else. But interestingly enough, that was always a relative value game. And so what raised my alarm in 2006, 2007 was seeing people more and more saying, well, if I buy this company at 11 times EBITDA and I sell this company, I buy this company at 9 times EBITDA and I sell this company at 11 times EBITDA, then I've got guaranteed 2 turns of profit, they're going to converge, right? It was basically the Greek credit trades that ultimately blew up a couple of years after the GFC in the 2010, 2011 time period. That for me is actually kind of an important distinction because that was ultimately all about leverage. And when Lehman Brothers went away, a lot of the cash that was used to execute those types of trades and the financing disappeared. People were forced to sell stuff. This is much, I would argue, I think we both would argue this is much more like 99. This is, we're going to adopt all sorts of new metrics, we're going to talk about ways to gauge these things, et cetera, but it's much more speculative in its construction as compared to leverage enabled.
You know, it's hard to figure out exactly what the right history comparison is, because there's just so many different aspects of things that are going on. You know, the big capital investment that's going on in data centers and stuff. I mean, you know, clearly that is what inning we're in, we can debate, but clearly it's somewhat analogous to what happened in the late 1990s and stuff like that. It just has to be. But some of the other behaviors that are going on, we didn't have them the same way in 1999. And part of it, in some ways, I mean, it depends what you think about the economy. I'm a little bit more of a view that we're heading into or have been in a recession, and like today's GDP number didn't make any sense to me at all.
Reversal of trade, but yeah, it's a huge contributor.
I mean, I look at it and say, well, you know, jobs aren't growing and the work week is shrinking and productivity is not that great, and those are the three factors, and it doesn't add up to 3.8%. And you know, if they're overstating the payrolls like they probably are with the birth-death thing, because they've had 2 years of major revisions and continued with the methodology, jobs are probably shrinking. So I'm not really sure where all the, you know, the growth is coming. If that's the case, then you're looking at a situation where you really kind of have kind of a lousy economy, but the market is kind of just whistling right on past that. And that reminds me much more like how 2007 kind of was, because you could see the companies were kind of struggling, but the market wanted to just make new highs and reward all the bank stocks and stuff like that. So I don't know. I mean, both of these are periods before I think things wind up heading south, but I think anybody who has a view that, you know, about valuations of things, you have to know that we're a pretty elevated risk spot that over a long period of time seems unlikely to be a, you know, like a great entry point to have equity exposure, which doesn't mean that we're not going to rally another 20% into the end of the year, because, you know, who knows what's going to happen.
So one of the indicators that leads me to agree with your assessment is if you look at GAAP earnings for the Russell 2000 at this point, they've now turned negative.
Yeah.
All right. On net, the Russell 2000 companies are losing money on a generally accepted accounting principles. What's unique this time is that the S&P earnings are going in the exact opposite direction. And so while the magnitude of the two has historically, or the absolute level of the two has historically been very different, in part because of the index construction, the direction has never, literally, I've never seen them deviate in this manner before. That suggests to me that there's accounting shenanigans.
No, there's 20 or 30 or 40 companies in the S&P that on an accounting basis are genuinely benefiting from the data center build out, and they're not Russell 2000 companies. And the rest of the economy is kind of struggling. So if you, and we see this, and we own chemical companies, we own paper companies, we own a home builder, we own companies in just like the regular economy selling to regular things, and they are all struggling. They are not reporting great results. They're facing very difficult economic conditions, and their numbers are not great. But on the other side of that, there's 20 or 30 companies that are taking their cash balances and buying stuff from each other to build out data centers and AI, and those are profits, or they're GAAP profits, or they're reported profits, and so those companies are showing perfectly good results. It's a very bifurcated thing, because there's one area of the economy that's doing exceedingly well right now, and it has a huge weight in the S&P 500, and it's probably carrying the earnings for the most part. That would be my take on it.
Do you, so, you know, you brought up this idea of the circularity, though, because that would be, there's a couple of points that people have highlighted as it relates to whether there is actually the endogenous profitability that people are highlighting. One is a question around depreciation that Jim Chanos and others have raised. And the other is this question of how do you properly account for those types of circular relationships where I borrow to buy your product, or I give my equity so that you can buy my product. How do you think about that in an accounting sense? Is this an inevitable, the piper must be paid, or is there something else?
Look, the numbers that are being thrown around are so extreme that it's really, really hard to understand them. So Apple goes into the White House and says, we're going to invest $500 billion in the United States. And you look at Apple's CapEx, and it's like, what, 30 billion a year or something like this. And their R&D is, I don't know, 30 billion a year. I could be wrong by 10 or 20 billion. But so they spend globally 50, 60 billion dollars on this. And they're going to tell the president, well, we're going to spend 500 billion in the US. Well, what is he talking about? Like that's like, where we are. And then you see Mark Zuckerberg goes in and says, well, we're going to do 600 billion. I guess that's 100 billion more than Apple. And maybe that's where he came up with the number, because 5 minutes later he says, well, to Trump, well, I didn't really know what number to go with, so I went with 600 billion. So he's like, it's like he's just finger to the wind in the moment, like 600 billion, like, hey, what the heck? And then, so now we have OpenAI today, they're $1 trillion, and they have like 10 billion of revenue. So I don't know where the trillion is going to come from. And these aren't like, $1 trillion is basically the book equity of the Mag 7. And OpenAI wants to invest in this much in the next number of years in data centers. And what I'm waiting for is I'm waiting for the company or the government or the entity that's going to say, I'm really, really excited that OpenAI is going to do this because I'm looking forward to being their first $10 billion customer to buy up all the services that they're going to be providing. And so I don't know, like this seems really, really strange to me. It seems to be a continued competition of people throwing out numbers which sound really, really big and really, really exciting that are not really measurable in the context of anything anybody's ever seen before. They're actually turning out to be like percentages of GDP. I mean, it's really, really impressive. So I'm sure a lot of this stuff is going to get built. Whether it gets built at the amounts, I don't know. And whether there's a return on this, like what the revenue stream is of actually people using the output and paying for it, I also don't know. This seems highly uncertain. I'm sure it's not zero, but there's a reasonable chance that there's a tremendous amount of capital destruction that is going to, come through this cycle.
So one of the papers that I've been emphasizing for people that is worth reading is Michael Jensen's 2004 paper that came out after the dot-com cycle called The Agency Risks of Overvalued Equity. And it basically highlights that this is almost exactly what we would expect to see in these conditions where the management teams themselves look at their equity as, well, it's basically free, right?
Yeah, but they're not, well, some are, but the big ones are not selling equity to do it. I mean, at least at this point, they're financing it out of the cash that they have from their monopoly legacy businesses, and they're reinvesting in it. But to get to the numbers that they're getting to, there's not enough equity in the world. I mean, the entire dry powder of the entire US private equity industry is probably $1 trillion. The venture capital industry is probably $300 billion. So this is not going to be funded out of equity. It's going to be funded ultimately out of debt. And you're seeing where that is, where companies are saying, well, we're not going to buy the servers, we're going to lease the servers. So there's a carry to all of this. And so ultimately, for this to advance to where it needs to go, ultimately it has to be a levered situation. And then so you're going to have a carrying cost supporting assets that have a indeterminate return to them. And it'll either work or it won't work. It'll be spectacular to see either way.
So, you have gone...
Which isn't to say, let me just say one thing, isn't to say that I'm bearish on AI or the technological innovation. Like if you went back to like 1999 or March of 2000, when you're at the absolute peak of the internet bubble, and we can agree now that that was a bubble, I think, hysteria, and you say, what is like the most bullish case for the internet? And then you sit here in 2025, whatever the most bullish case for the internet was in 2000, it was not bullish enough. Like we didn't have Wi-Fi, we didn't have iPhones, we didn't have iPads. No one thought we were going to be watching all of our TV stuff, streaming, and all of the things that we do on the internet today. Like so few of them were visible in 1999 or 2000. And I suspect when we sit down 25 years from now, you and I, and we do our next version of this, we will probably think that AI or AGI or whatever it is has turned out to be wildly more important than whatever it is that we think or whatever the most bullish person is. I just think it's a separate question as to whether spending $1 trillion a year or $500 billion a year to build this out as quickly as possible is going to lead to good consequences for the people who are making those investments, which is very different from how will this technology eventually evolve such that we'll look back at it in 2050 and say, wow, that was really, really important what was going on.
It's interesting because as I look back and I think about that time period, and I think we both agree for almost the same reason, right? We spent a lot of time talking about the components in the aftermath of the dot-com cycle, trying to explain it. And one of the theories that emerged is this idea of a social capital bubble, right? That is effectively a way of pulling forward investments and getting infrastructure constructed that otherwise might not happen, right? And I think that's really what you're saying. You're like, absolutely, you're using AI, I'm using AI, they become regular parts. I actually was just in Hong Kong for a week and discovered that I was blocked from access to ChatGPT, right? And it was a very strange feeling. I felt like I'd lost a finger or something, right? Like it has become a truly integral part of my daily life in terms of how I conduct my activity. I also, funnily enough, was thinking about the transition in the mid-1990s. I started, I remember in 1994, we coined the term sneaker net because we had not yet gotten an actual network in our offices. And so the sneaker net was, hey, could you get me a copy of that file? Sure, I'll download it onto this 3.5-inch floppy, and I'll run over to your desk and put it into your computer so you now have a copy of it, right? And so they're like, that world is unimaginable to my children. Right. It's, they send me files on my phone all the time. I'm like, could you send it to my email? I can't read it on my phone. And they're like, well, that's just because you're old, Dad. But it is an unfathomable world coming from SneakerNet to where we exist today. But those were bad investments, right? Or at least some of them were bad investments for a period of time. You famously highlighted one of them that was viewed as a terrible investment in 2013. You emphasized Microsoft trading at then, I think it was 13 times earnings, not net of cash. Net of cash, I think it was about 8 or 9. What multiple of revenue would that leave it at?
2?
Yeah, something like that. When you identified that from the value framework, right, was there any indication of what could happen on the revenue side, or you just really saw the margin of safety there?
Look, revenues were still growing low double digits. So you had a company there that was trading at 8 or 9 times the unlevered earnings, and the revenues were growing 10 to 12%, and the profits were going 12 to 15%, and you were getting it at a discount to the market, and at a like a low double digit multiple, even if you didn't back out the cash, and it just seemed like a really great investment to me.
So I actually had a very similar experience on the fixed income side, looking at Microsoft in early 2009, right? And there was a ton of questions. You obviously remember that time period about where were they going to get redemptions, et cetera. Lots of cash was raised, which I think is what really drove that final low. But like you could literally pick up Microsoft investment grade, quote unquote investment grade debt. It was yielding 12, 13, 14% for a 5-year period. These are not companies that have always been valued this richly. The narrative was totally different back then. Then they were viewed as dinosaurs that couldn't grow. And in many ways, I look at Microsoft today and they've, perhaps acceded to your point to some extent by saying, we're going to hike the price of Microsoft Office by 30% this year. Your functionality has improved dramatically, right? You mentioned the idea of monopoly. Is that a critical part of what we're experiencing right now?
Well, look, I think the big tech monopolies are well understood and well entrenched. I think, I think you see that in the financials. These have been absolutely spectacular businesses for the last 15 years or more. Like even through the down cycle, a lot of them were really very
outperformers, yeah.
Very, very spectacular business. Even sometimes the stocks weren't performing, but the businesses were performing. When we owned Microsoft, the stock wasn't performing, but the business was was performing. And everyone has allowed them to persist in their monopolistic stuff, and there's occasionally a little foot pushback from the government, but like you just saw it with Google and in the Google case where the government like proved its case, and then the judge decided like, well, you know, times have changed, so we don't need to do anything about it. So the Google monopoly will persist. I don't mean to judge it as good or bad. I do think these businesses are now changing. They used to be capital light, cash generative, and now they're taking their cash and they're deploying it in this next FOMO AI thing. And they're certainly going to become much more capital intensive than they were. And you can get into arguments about the depreciation schedules, but at the end of the day, that's just this year's earnings. If you think about it over 5 or 10 years, it doesn't really matter what the depreciation schedules are. You'll see that the capital went out, and the cash flow, the net cash flow was less than it historically was, and maybe it will earn a return back, or maybe it won't earn a return back, but it probably won't return the way that it has, because the genius of these platforms, the software, selling the next copy of Windows doesn't cost anything compared to writing the code in the first place, and the same has been true of Meta and Facebook and Google, and you've had these leverageable platforms where the amount of work they do is kind of fixed, and then they can scale the economics and raise prices on a continued basis, and these have just been marvelous businesses. It's very unclear to me, and maybe it's clear to them, but when you actually hear them talk about it, I don't think it's clear to them at all. They just feel like they have to do this. And so I think they're transforming their businesses, and their returns on capital, I think, are likely to diminish over time.
Well, one of the things that I remember about the 99 era is we used to actually get S1 prospectuses when companies went public, right? We don't get that in SPACs and various other stuff. eToys was one that I remember very distinctly, had a clear disclaimer in its prospectus that if they were unable to tap capital markets, they would run out of cash by March 2000, and lo and behold, March 2000, they filed for bankruptcy. Is there anything that you're seeing out there as you spend your time looking in 10Ks? I know to a certain extent you're avoiding many of these companies, but what are you looking for in 10Ks at this point to either identify that endogenous and durable business or things you might want to short?
Look, we're reading the 10Ks more on the longs. Mm-hmm. We're really trying to understand the economics and see that we're getting the cash-on-cash returns that we're looking for. And there we're studying the financials as carefully as we ever did. I've come to the view, relating to the short side of the book, that this is basically a wasted effort, because nobody is reading them. Nobody cares what they say. You're not going to figure anything out. If you did figure it out, it wouldn't really matter anyway. So we're looking for shorts that have a different dynamic than accounting issues. Like, we're not going to get into an argument as to whether Microsoft should be depreciating its servers over 5.5 years or 4.5 years and think like this makes some difference, because I don't think anybody will care. It's the same thing we went through a number of years ago, like we still do with the stock compensation, right? The non-cash stock comp, which is clearly an expense, because if you didn't pay the workers the stock comp, they wouldn't come to work. And then you take your cash flow from your business and you repurchase the shares to offset the stock comp. So it is a cash expense. It's just you're using it to buy stock instead of paying it directly to the workers. Or you suffer the dilution in any case, and no one builds in a dilution factor for all this. And you can analyze this stuff to death, and maybe 15 or 20 or 30 years ago it would have mattered, but since we fired the professional investor class and the people who are buying these stocks, it's not that they dispute this analysis, they're unaware of this analysis, and they're happy to blissfully remain unaware of this analysis. I don't see it as useful in our portfolio construction to try to really get into the nuts of this kind of stuff.
Well, it's an interesting point that you raised, and again, it ties back to conversations you and I have had in the past, right? I mean, part of your short approach was uncovering this and then making people aware of it, right? And the idea was that people would use this information to effectively evaluate whether your claims were accurate or were not, and could join you in the process, bringing additional capital to it.
That's right. There was a period of time where I felt that introducing additional information and analysis into the market was a positive social function to foster the debate and help resolve what the correct valuations of securities are. And I no longer believe that to be the case.
It's a sobering comment that unfortunately we see evidenced in both the academic literature, as a paper in 2017 by Davidson Heath, who has been on my program, that highlights exactly this function, right? The minute a stock enters to an index, the fundamental information production falls. And the extension of that I would highlight is that the most valuable information is now actually information, and again, this is something you and I talked about, is effectively the behavior of that 17% of the market that doesn't care, right? And that's the payment for order flow that Citadel and others are receiving.
Right, and I would just assert that it's even much broader than that.
Okay.
All the quantitative strategies, all the systemic strategies, all the momentum strategies, all the non-fundamental strategies, all of the pod shop strategies, which are not interested in what something is worth, they're interested in what the next piece or two of data will be and how the market will react to whatever the next piece or two of data is, because all they care about what's the next item and what's the item after that. Going one more item beyond that is beyond the horizon, because they'll change their position before you even have to bring that into the window. And so the result is none of these players are caring about these dynamics. And so it's not like, well, you take the index fund and then you have the active community and you take out the retail. I think you also have to take out a huge percentage of what remains of the institutional active managed community, because I don't believe that they care about these things. So you're literally left as like the Maytag repairman. Nobody cares, you're all alone, and you have to just recognize that nobody is going to care, and trying to persuade people to care is a waste of breath and effort, so there's just no point.
So one of the things I like about you is that while you are more than happy to go out and share your public views, you are also very happy to keep them private. You're not a naturally gregarious person. You're not somebody who feels a need to seek that public validation, although it was nice when it came in the form of returns. When you do talk to people today about your perspective on markets, are they sympathetic? Is it the world's smallest violin playing for a hedge fund guy? Is it?
I'm not looking for any sympathy.
Yeah.
I don't think I'm a victim. I think I'm very lucky. I mean, I've had just this phenomenal career, and I continue with it. And every day I'm excited and go in to work and to try to, compete and do the work that we do. And it's a joy and a pleasure, and it's way better than like manual labor or other things I wouldn't like to do. And I just feel really blessed. I don't think anybody should have any sympathy for my view that when I'm saying like markets are broken or this or that, I'm not saying woe is me. I'm just stating it as an observation, as a reality, because I think it's important, if we're going to be market participants, to understand the reality as it actually is. I don't have some nostalgic view that we're going to go back to how things were in the 1990s or the 2000s. If the big mutual funds have fired hundreds, if not thousands, of stock analysts, I have no illusion that those people's jobs are ever going to return. The market structure has changed. It will probably change in the future in some other way, but it's not going to change back. And I'm not looking for any sympathy. I'm simply pointing it out because I think it's interesting to talk about. I hope the audience here appreciates the insight and can either agree or disagree, and that's all fine and well. And that's really kind of the purpose of it. I do feel like our business was hurt for about 5 years when I didn't figure this out. We had a period from 2015 to 2019 where we really suffered at Greenlight because the market structure was changing and I had not figured out that it changed. So I was continuing to do what I had always done, figuring out that it would work. And when it stopped working for a little while, I figured, well, if I was just a little bit more patient, eventually it would come back to working. And as you and we sat down, I think it was in 2018, and we began explaining it to me, I began figuring out why it wasn't working. And so now we have to adapt to it. So when I say markets are broken, like I said, it kind of depends on what your perspective is. But if your perspective is a traditional view about the purpose of allocating capital and the rest of it, that's not woe is me. That may be woe to the society, or it may be woe to the people who can't get capital who deserve it. And it also, may be a benefit for people who don't deserve capital who are having it showered on them. Whatever that happens to be, I'm just pointing it out for observation and for discussion. I definitely don't need violins played for me of any size.
So one of the things I love about you is your recognition of how fortunate you are, and it's unusual. Are policymakers aware?
No. I don't know what to tell you beyond that.
Yeah.
And I don't talk to them about it to the extent I do. In fact, I've even given up on talking to them about the fiscal situation, which is what I used to think talking to policymakers would have an impact on. But they don't. They're aware, but there's a bipartisan understanding that we're just going to run that one right into the wall, and we'll deal with it once it hits the wall.
The world's largest violin just started playing for all of us. Are there implications associated with the policymakers being unaware that you think are exacerbating the potential risks?
Look, we don't have a functioning SEC. We haven't had one functioning for a long time. At best, they can find somebody whose uncle who overheard something at a dinner table and bought call options 1 minute before something good happened. Maybe they can get to that. But beyond that, they're not doing what they used to do. They're not policing corporations or even policing accounting. Like it used to be, if we were going to debate how fast to depreciate servers, the SEC would actually comment and say, how long are we going to depreciate? They're not doing this. And that was the lowest level of functionality. I'm not talking about even restating accounting or putting people in penalty or fines or anything. The SEC is essentially, they've left the scene a long time ago. Look, this is not news. I wrote Fooling Something all the people all the time in 2008. It was pretty clear there wasn't much of an SEC for this kind of stuff then. And 17 years later, it's they're completely vacant. So no, there's not regulatory oversight to police any of this kind of any kind of the malfeasance that may be going on.
Do you think that's a capacity question, or do you think that's a desire question?
Oh, I think it's political. I think they've strategically said that somewhere along the line, I think it was around Cox as the chair, who basically said, if we do anything to any of these things that will make stocks go down, and then we're effectively punishing shareholders who are therefore the victims of the fraud. So if the company's committing fraud and you punish the shareholders, the shareholders didn't commit the fraud, so we just let the stocks go up. And everybody wants the stocks to go up, and nobody wants the stocks to go down. And so we're not going to do anything that's going to have any stock go down. If we ever do have an economic down cycle, and we have some bankruptcies, all right, they may do some stuff around them if they're glaring enough. We could still go after a Bernie Madoff if he implodes, once he can't return the money. I think there's still enough enforcement for that, post-bankruptcy, but there's nothing there in a preventive fashion, and it's by design. It's not incompetence or laziness. It is the strategic political direction of the regulator.
So this is one of the things I argue all the time, and I use the phrase, we are asking markets to do too much, right? So you highlighted the traditionalist view, which is that markets are about allocating capital. Somewhere around the ownership society and George Bush, we decided that markets were actually about funding retirements. Is that the core of the situation in your mind?
Well, for a section it is, for sure. I mean, the people who are not real active market participants, who are taking money out of their paycheck every 2 weeks and depositing it into their index fund 401k, the function of the market is to provide for their retirement. That's why they're investing, and it's a major function for why we're here. It's a positive function. I think that's a great thing, and certainly on an individual basis, we have criticisms about passive or indexing. You certainly shouldn't blame individuals who are acting in their own best interest and participating in it. Like, I don't think there's anything to criticize, and I hope markets perform well enough that when it comes time for them to, take that out to fund their later years or whatever they want to do, that it's there for them. Like, that's a great function of the market.
Yeah, I think part of what's so interesting to me is that many of particularly the crypto panel, we discussed an element of paternalism or patriarchy that exists within the traditional regulatory function. We can't allow people to do this. You and I are both old enough to remember Massachusetts famously banned the IPO of Apple because it was overly speculative, right? So if you were a citizen of Massachusetts, you could not buy into the IPO. That was true paternalism in many ways. Today, the paternalism sits in somewhat archaic forms of an accredited investor as somebody who makes $200,000 but not $195,000, right? But there is a tone of nihilism or anarchism almost that has permeated, that is increasingly of the line similar to what would have come out of Massachusetts post-1986 of, how dare you tell me what I can and cannot buy? It feels like that is been one of the components that's playing through.
There used to be suitability requirements, and it wasn't just for accredited investors, it was for everybody, and brokers had to understand who their customer was and what their goals were and what their financial plan was, and they had to put them in investments that were suitable. The thing is it's not like if you open up a Robinhood account, there's any questionnaire that's going to lead to a determination of suitability. So anybody who, makes a little bit of money on DoorDash, if they want to take that money and buy, S&P call options that are expiring tomorrow at 4:15, that's what they can do. And we've given up on any kind of oversight or limitations that are functional for this. There still might be a few private partnerships and hedge funds or private equity that they can't yet invest in. There's efforts being made, I know, to unwind whatever remnants of that is. I don't think it's a big deal either way. I mean, we've gone this far. Really, are you really going to tell them to put their clothes back on now? I mean, the only thing I know that we're really not close to, and it's very important that we maintain this as a society, but it remains completely illegal to play online poker in New York. And so if I want to do that, for $50 after dinner, that is not something that is permitted.
I'm not even quite sure how to move on from that one. I just have this visual of David, we should take away the punch bowls. Everybody's in an orgy. But let's do this, actually. We've run over a couple of times. I've monopolized your time. Let's open it up to the audience and get some questions. I'm sure there's one out there. Oh, hands go up all over.
Thanks for your time today.
Sure.
Yes.
With fewer stocks to select from, much greater market participation, do you think some supply and demand dynamics that justify a overall higher valuation of multiple market?
No, I don't think so. I don't think that's really a thing. I think there's plenty of stocks. I can find enough really cheap stocks that everybody hates to still fill out a portfolio. I've seen these kinds of analyses before. It's the old "there's no alternative." But the thing is if valuations get too high, they're always happy to make more. The more comes in IPOs or new crypto things or sports franchises or whatever. There's no shortage of places to deploy capital. The capital markets are extremely large in notional figures. They're large relative to GDP. So if you say, well, how much stock was there relative to GDP 30 years ago when there were, quote, twice as many issuers? It's probably less, because I think we're near a record market cap to GDP. So I think there's plenty of market cap for people to deploy in, and I don't see why this would justify, higher prices per se.
Chum in the back.
private credit investors and them holding positions at par even though the company's not making payments and can't make payments. Is this an allied capital situation?
Well, of course, in a sense, it is. And as I learned with Allied Capital, it's not that we were wrong in 2002 when I brought it up, but it didn't matter until 2008 when we had a recession. And the private credit will be fine. We haven't had, we've had a couple of down ticks in the economy. We had a COVID down tick. We've had a couple of other down ticks in the economy. But we've had relatively rapid recoveries. And so entities that are investment entities, private equity, private credit, venture capital, and so on and so forth, have been able to take a perspective of, this will pass, and we don't have to mark right now. And in 6 months or a year, maybe we'll earn a little bit less because we kept our marks higher, but we can lower volatility by doing this. I'm on an investment committee, and we have one of these consultants came in and explained to everybody how private equity adds return and lowers volatility at the same time, even though it's basically it's still levered equity, which would seem to be higher volatility regardless of what you think the return actually is. But statistically, that's what's being sold and what's being understood. Eventually, there will be a downturn, and it'll last more than a quarter or two, and then you'll have defaults. And when you have real defaults, it's going to be very interesting what happens in private credit, because these are not banks, they're not regulated. I'm sure they have workout groups, and if they have 100 companies in their portfolio and 3 of them are going through restructurings for whatever reason, I'm sure they have the resource for it. But if we have a correlated down cycle where all of a sudden 20 or 25% of their portfolio is in distress and needs a lot of elbow grease from professionals at these private credit institutions, it's unclear whether they're actually staffed with sufficient numbers of people to do all of these workouts. And you can say, well, we'll staff up then, but when that happens, everybody's going to want to staff up at the same time. And I just don't know that we're going to have the expertise to get through that. And I think you'll wind up with some pretty interesting situations and some distressed opportunities to buy. I mean, I can't tell you how many times I've gone to my investors and I said, well, I think we're 6 to 9 months away from a real distress cycle, and I'm really looking forward to buying some distressed credit from somebody. And we never really actually get there. It's been a long, long time, but at some point it'll happen, I think, and then we'll see where we are with private credit, because the thing with credits is sometimes they actually do go bankrupt.
You brought up a fantastic point that I just wanted to emphasize, which is this idea of almost like backlog of work to do, right? One of the reasons the GFC was so bad in the housing markets was that there were not resolution processes established for what happens in mass mortgage defaults. You brought up a really interesting point. Our private credit company is staffed up properly to handle the renegotiation process on credit contracts in the event that there is a large credit event where numerous entities are going through it. It's absolutely one of the things that we've seen over the last couple of years is this component of dribs and drabs of distressed securities basically create lots of opportunities for restructuring and thinking creatively because nobody's really freaking out. If that changes, I agree with your analysis. That's a really, really important point.
David, he's calling on. I shouldn't point. Go ahead.
Do you want me to wait for a mic or just wait?
I can repeat your question if the mic is hard to get to. Okay, but it looks like it's coming over.
Thank you very much. So as we make new highs every day, priced in gold, it doesn't seem as shiny. So should this be a warning or is it just an inconvenient truth?
So did I understand the question correctly? As we hit new highs, the price of gold doesn't seem as shiny.
I'm sorry, I'll rephrase. As equities make new highs every day, if you price equities in gold, it's not as shiny. Is that just an inconvenient truth, or is that potential concern.
Do you assign any value to things like pricing in gold?
No, I don't. I think we're a dollar-denominated economy, and I think that's how people generally live their lives and think about things. I happen to be a big proponent of owning a lot of gold, and we've owned a lot of gold for about 15 years. But I don't know that comparing equities to gold is terribly relevant. I don't know.
David, thank you for coming out today. Quick question. You mentioned that you no longer use, I would say, accounting fundamentals in your short analysis as much. Do you use it still on the long side, and why is that different, A? And then I guess as a follow-up, what are you using when you determine what to short out there? What are the different factors that you think about?
Yeah. Look, on the longs, we're trying to underwrite to the actual economics of the business because our theory is we want to be paid out of the cash flows of the business. We want dividends, we want buybacks. And so we're looking for unlevered companies with relatively straightforward businesses, with relatively straightforward accounting. We're not looking so much for, hey, we used to have a lot of companies where we would say, hey, they say they're earning $1, but we really think economically they're earning $1.50. And so it's cheap on that basis. We are still saying what are they economically earning, but we're trying to then convert that back into how much cash are they going to put into my pocket in dividends and buybacks. And so the analysis is much simpler, but it does require a general review of the financial statements and make opinions to make sure that we're not missing things. So if there's factored debt or other things like that, we really do want to make sure we understand. I continue to use a very conservative view towards like stock comp expense. I'm not looking for cash flows that are really being handed to employees in the form of non-cash stock that then effectively dilutes or has to be a use of cash to buy back. So we do that kind of analysis because we're looking at these things, I would say on a traditional basis, just with a really cynical view that no one's going to care. And so we're not trying to find them so that we can tell people about them. We're trying to find them to make sure that we're buying things at the prices that we think are attractive to us. On the short side, there's just no point in this exercise. So we're looking for situations where there's more obvious deterioration or more obvious problem that are more likely to come into focus based upon the way people actually do pay attention to things.
We have time for probably one more question.
Yeah, I had a quick question on,
Yep.
I was hoping if we could just take a step back and look at the market structure of the fact that there's so little people that are now looking at kind of fundamental value. How does that impact like time horizon as far as from an investment perspective? Like how long does it actually take for the market to come around to kind of your viewpoint?
Oh no, my view is the market isn't going to come around to my viewpoint. And it's not that I need to be more patient. I've come to the view that the market is no longer trying to drive efficiency by bringing things towards convergence to value. Like I don't believe that is a fundamental behavior of the market. So it's not like I think, well, if I just wait a little bit longer, people will figure it out. I've come to the view that no one's even trying to figure it out. And if no one's trying to figure it out or no one's qualified to figure it out because we fired all the people who could figure it out, what makes me think that people will figure it out? They're not going to. And so I don't know whether that lengthens my horizon or shortens it, but it does is it forces me to be much more disciplined on my entry price to make sure effectively that I think I'm being paid by the companies. And I don't care so much what other people are going to think.
Thank you.
Sure.
One of the things I just highlight very quickly about that is you read the stories about Warren Buffett going in and identifying securities in the 1940s and 1950s, and the overwhelming statement that he makes over and over again is nobody cared, right? Nobody was doing this at the time. Nobody had any interest. You're effectively saying, I'm carving out a bubble for myself where I'm perfectly comfortable sitting there and doing this for the next 20 years and having nobody care who I am. Is that?
More or less, I think that's about right.
Okay, one more question.
Hi, David. You've kind of bemoaned the fact that there's far fewer analysts today than there were 10 or 20 years ago. It seems to me that the marginal cost of a research analyst is trending towards zero with the advent of LLMs, where the cost is really just the next token, when every Robinhood trader has a David Einhorn analyst in their pocket? Do you think kind of this current view of the market being broken might be an antiquated view in 5 or 10 years when anyone can ask what is the fair value of a stock?
I think it's a great question, and I think the market structure will change. Like, it's changed, and it might be that we don't need professional investors and that individuals will do that. It starts, though, the change that has to happen is the people who are planning to actually deploy money have to think that the right question to ask the AI is, what is the fair value of the stock? And I think their inclination is not to ask that question, at least not now. Their inclination is to say, which stocks are going to do best over the next 3 months, or the next 2 weeks, or the next 2 hours. And so as long as the focus primarily is on the price of the stock, as opposed to the value of the stock, I'm not terribly optimistic that what you're saying will hold out. Although I do agree with you that the ability to comb through financial statements and gain insights. Look, when I started my business, this was, earnings used to come out on the Dow Jones tape, and you'd get the thing, and you'd print the earnings, you'd print the release. You wouldn't even read it on the screen. And so you had to hit print, and then you had to walk over to the printer, and you had to wait for the paper to come out, and then you had to read the earnings. And usually, let's say company announced earnings at 4:15 in the afternoon, and they're having their conference call at 5 o'clock. You could read the earnings, see that the market was trading in the aftermarket and like the earnings, and you could read the earnings release and see that there was a problem in the earnings release on the 4th page where they basically just admitted the business is about to fall apart, and you could actually sell the stock or short the stock before the conference call started. Think about how antiquated that is, because that doesn't happen anymore. The machines read the earnings before I can even figure out where they are on my Bloomberg screen, let alone read them. And they've already priced themselves in. So the idea of things I used to be able to do and make money at are going to disappear is not a new phenomenon. And I do agree that it's quite possible that you could say, look, can you AI, can you tell me what a fair discounted cash flow value, risk adjusted under multiple economic scenarios is for this, and it can spit out a number or a range of numbers, and it can probably even be accurate in a traditional sense, or not forecasts are never accurate, but it could certainly be a reasonable or responsible analysis. But I just don't see that as the fashion that's then going to lead people to say, hey, my AI tells me that Procter & Gamble is worth 35% more than it's trading at today. I'm going to buy Procter & Gamble, and if I own it long enough, I'm going to earn S&P plus 35 over some indeterminate number of years. I just don't quite see how that plays.
I think, unfortunately, that is a brilliant place to end. I love, actually, what your response was there. It depends on what the question they're asking is. And this is, I think, frames so much of what is going on in our society at this point. David, that was amazing. Thank you so much for joining us again. I appreciated
Thank you all.